I am an AI assistant. Before you start your day, I will summarize today's news article for you. Former U.S. Treasury Secretary Lawrence Summers has warned that the chances of a U.S. recession are increasing, following a series of weak economic indicators. Summers also suggested that the Federal Reserve is coming to the end of its interest rate hike series. He called on the central bank to review how savings are intermediated into lending, and said it needed to undergo some serious soul-searching, highlighting that business, as usual at the Fed, has not been successful over the last 2.5 years. According to data from the U.S. Bureau of Labor Statistics, non-farm payrolls rose by 236,000 in March, which was in line with expectations. The unemployment rate dropped to 3.5%, near a record low. The data suggests a resilient labor market, with payrolls having risen by more than 1 million since the start of the year, and raises the possibility of the Federal Reserve increasing interest rates at its next meeting. However, there were signs of cooling in the labor market, with wages rising at their slowest pace since June 2021. Additionally, the average workweek declined, and temporary jobs fell. Investors are betting that Asian banks and emerging economies are in a better position to weather the fallout of the U.S.-led banking turmoil. Citibank's analysis shows that Asian financial markets have tightened less than in the U.S. and most Asian currencies have gained ground against the U.S. dollar. An index of financial stocks in the region, excluding Japan, has risen since March 10. An end to the cycle of Fed hikes could aid Asia by easing pressures from a strong dollar on external finances and reducing the appeal of the greenback as a safe haven. However, there are still risks as Asia is not completely immune to the financial instability that spread from the U.S. Russia claims to have cut its oil output by about 700,000 barrels per day in March, which is inconsistent with data on the nation's March seaborne exports and domestic refinery runs. The Russian government had pledged to reduce crude-only output by 500,000 barrels a day from March to December. The voluntary cuts agreed by 8 OPEC members brought the total reductions to more than 1.6 million barrels per day in an effort to stabilize the global market. U.S. bank lending dropped by almost $105 billion in the final 2 weeks of March, the most in Federal Reserve data back to 1973. Economists are watching the Fed's H.8 report, which provides a weekly aggregate balance sheet for all commercial banks in the U.S., to assess credit conditions. The recent bank failures have complicated the central bank's efforts to reduce inflation without causing a recession. The American Bankers Association Index of Credit Conditions fell to the lowest level since the pandemic's onset, indicating that bank economists expect credit conditions to weaken over the next 6 months. Bond traders are speculating that the Federal Reserve may implement one more interest rate hike, as the U.S. economy shows resilience despite recent banking turbulence. Treasury yields rose on Friday after a fall in U.S. unemployment and higher than anticipated payrolls. Data suggested the Fed may raise rates by 0.25 percentage point at its next meeting in May. The prospect of another rate hike is expected to be confirmed by next week's Consumer Price Index reading, which will indicate whether inflation is being kept under control. Global food costs have fallen for 12 consecutive months, according to the United Nations Food Commodity Index, marking the lowest level since July 2021. However, food inflation continues to rise in many countries, offsetting cheaper commodity costs with other expenses, such as energy, labor, transport, and processing. The decline in food commodity costs is driven by a combination of ample supplies, weak import demand, and the extension of the Black Sea Grain Initiative, according to the FAO.